Knowing your own financial bedrock, your liquid assets, existing debts, your emergency fund, is just as vital as analyzing the external market risks before you even think about making a move. So, okay, before properties, the absolute first step is understanding the potential pitfalls, assessing risks, not just generally, but like specifically.
Precisely. And the sources don't just say risks exist. They really push you to understand your personal risk tolerance and your investment timeline, which is critical because what feels okay for one person might be, frankly, terrifying for another. We're talking external factors. Sure, economic downturns, those market fluctuations, they can look really different depending on the specific market segment.
Mm.
Luxury condos versus suburban homes, for instance. And regulatory changes too, like zoning or tax shifts.
Hmm.
But the real question it forces you to ask is, how much volatility are you actually comfortable with? Not just on paper, but, emotionally. And over what time frame are you looking for returns?
Okay, and this next point, I found this really eye-opening when I was going through the material. The guide doesn't just say use data. It practically turns you into a market detective.
Ah,
It gets specific about which data truly matters. Like, it points out that looking beyond just population growth, maybe digging into income stratification within a specific zip code, that can be a much better predictor of rental stability and appreciation. And here's a cool little nugget. Sometimes the best intel isn't even in the public reports. It's from talking to local property managers who see demand shifts weeks before the official stats catch up.
that's right. Boots on the ground.
Exactly. So it's about researching market data, demographic trends, local economic conditions, like with a fine-tooth comb, evaluating risks in specific spots, not just painting with broad
Yeah.
strokes.
Hyper-local knowledge.
So once you've mapped out those potential dangers, the next logical step is, well, what do you pursue? After all that risk assessment, how do you pivot to spotting the really good opportunities? The real estate world is huge. Where do you start narrowing it down?
Yeah, and that's where the guide really helps, I think. It lays out the sheer diversity of investment options available. It's not just about buying a house down the street. The sources detail, obviously, residential properties, single-family homes, multi-units, the usual suspects. Then there are commercial properties, office buildings, retail, industrial warehouses, a whole different ballgame. And also real estate investment trusts, REITs, which the guide clarifies aren't all the same. It distinguishes between equity REITs, owning the actual buildings, and mortgage REITs, which deal with the financing.
Ah, okay. That's a key difference.
Huge difference. Their risk profiles, their income streams, they vary significantly. Think about it. A data center REIT versus a shopping mall REIT. Totally different exposure to market trends and tech shifts. Understanding that nuance is vital for genuine diversification. So the key is evaluating the pros and cons of each type against your specific goals and that risk tolerance we talked about.
Right. And it's not just about picking a sector that looks good. The guide also digs into the practical stuff for evaluating individual deals. We're talking location specifics, not just the city, the neighborhood, the actual condition of the property. Is it ready to go or does it need work? A value add play. Then there's the rental demand right there, looking at vacancy rates, how long properties sit empty, and of course, the potential for appreciation over time.
Absolutely.
It's got to make sense on the ground. The sources really push you to look at metrics like debt service coverage ratio for commercial, or even just a simple gross rent multiplier for residential, just to get a clear snapshot of how that asset might perform right out of the gate.
Get the real numbers.
Exactly.
I see.
So once you start finding those opportunities, maybe making a move or two, the next step isn't just buy one and done. It's about building a real estate portfolio, thinking bigger picture, not just signing one star player, but like assembling a whole team designed to win financially.
Well put. And a key insight from the guide here is that diversification, it's not just jargon. It's a core strategy in real estate to spread your risk and potentially boost returns. The sources strongly suggest investing in different types of property, maybe mixing residential with a small commercial spot, and crucially, across different locations.
Right. Don't put all your eggs in one geographical basket.
Exactly. It's about smart capital allocation across different assets based on their return potential and their specific risks. So the question for you becomes, with the capital you have, are you building a balanced portfolio that can handle different market storms? Or are you maybe, without realizing it, overexposed somewhere? The guide even talks about diversifying within a type, like owning both single-family rentals and maybe a duplex, to manage different tenant pools and market cycles.
Okay, that makes a lot of sense for spreading risk. But let me just play devil's advocate for a sec. For someone starting out, maybe with limited funds, isn't there an argument that focusing really hard on one great, well-researched property might actually be less risky at first? Rather than spreading yourself too thin across several smaller, maybe less understood assets? What does the guide say about that?
That's a really good question. And yeah, the guide actually addresses that pretty directly. It acknowledges that for smaller initial investments, going deep on a single high-quality asset can be a strong strategy. The key, though, is that single asset has to be exceptionally well vetted. Location, condition, cash flow stability, all rock solid. And you need robust reserves for surprises.
Okay, so quality over quantity initially.
Potentially, yes. Diversification might then come later, maybe by adding larger assets as you grow, or even through things like REITs for that instant, though indirect, portfolio spread. But the main principle is always risk management, whether you achieve it through intense focus or broad diversification. And it's definitely not set it and forget it. The guide hammers this home.
Yeah.
You have to continuously monitor and review your portfolio, make sure it still aligns with your financial goals, your risk tolerance, because those things can change. Markets shift, your life shifts.
Yeah.
The portfolio needs to be agile. Okay, all right. So you've done the risk assessment, you've found some promising opportunities, you're thinking strategically about the portfolio,
Sure.
but then comes the big one.
Yeah.
How do you actually pay for it all? Funding.
Yeah.
Often the biggest hurdle, whether you're brand new or you've been doing this a while.
Yeah.
Yeah, the money question. And drilling down, the guides lays out a really interesting range of options, way beyond just walking into a bank. Traditional mortgages are there, obviously, but it also sheds light on private loans offered from individuals, maybe investment groups. More flexibility sometimes, but maybe higher rates.
Right.
And seller financing, that's an interesting one. The guide notes it often means the seller acts like the bank, but maybe for a shorter term, possibly with a balloon payment looming.
Ooh, okay, so you need a plan for that endpoint.
Definitely need an exit strategy like a refinance plan. It could be great for speed, bypassing some lender hoops, but you've got to negotiate terms carefully. Interest, down payment, those exit clauses. Partnerships, too, pooling resources. So yeah, it's definitely not one size fits all. Comparing rates, terms, who qualifies across different lenders or sources, absolutely critical. Finding the best fit for your specific plan.
And the sources don't just stop at finding the money. They really stress the importance of running the numbers before you commit. Calculating potential cash flows, listing out all the possible expenses, projecting returns accurately.
A pro forma, yeah.
Exactly. Assessing if the project is actually financially viable. So the big takeaway here, do your homework on the numbers. Seriously, don't just get swept up in the potential. Confirm the profitability with hard data. Factor in everything, taxes, insurance, vacancy, repairs, the works.
Know your numbers cold.
Right. Okay, so you've got the financing, you own the property, but the adventure definitely doesn't stop there. For many, this is where the real work starts. Property management and maintenance. This is the next huge piece. It's not just about acquiring, it's the ongoing care that really determines if you succeed long term.
Absolutely. Expanding on that, the research really points to effective property management being, well, crucial for profit. The sources detail the key parts. Thorough tenant screening, huge for minimizing vacancies and problems down the road.
Yeah, finding good tenants is key.
Paramount. Then ensuring consistent rent collection sounds easy, but often needs a solid system. And then handling maintenance and repairs efficiently. The guide actually shared a little story, and an investor who got fixated on just maximizing rent kind of skimped on minor repairs.
Uh-oh.
Yeah. Saved a bit up front, but it led to unhappy tenants, higher turnover, and eventually a big hit to profit when vacancies stacked up. Really shows you need that long-term view. So it raises a big question for you. Are you really prepared for the day-to-day stuff, the landlord responsibilities? Or is a hands-off approach maybe more your style? In which case, professional help might be the answer.
That is such a vital point to consider. And the guide wisely suggests looking into a professional property manager if you do prefer that hands-off style, or maybe you just don't have the time or, frankly, the expertise. And no matter who handles it, you or a pro regularly reviewing those key metrics is essential. Rental income versus expenses, vacancy rates, how long tenants stay. It keeps you honest about whether your investments are truly profitable and working for you. It's about proactive management, not just putting out fires.
Staying ahead of the curve.
Exactly. So, wow, we've covered a ton of ground, from risks and opportunities to portfolios, financing, even the day-to-day management. But a real estate plan, as you said, it's not static. You don't just write it and file it away. It's dynamic. It's alive, always moving. Which brings us to the final, really crucial step: continuously monitoring and adjusting your plan.
Yeah, the sources really emphasize how proactive this last step needs to be. It's about setting up clear, key performance indicators, KPIs, things you can track consistently to see how your investments are doing against the goals you set initially.
Like what kind of things?
Oh, things like cash-on-cash return, occupancy rates, maybe average rent per square foot in your area, even tracking year-over-year appreciation in your specific neighborhood or submarket. And then, critically, reviewing and adjusting the plan periodically, maybe quarterly, maybe annually, based on what's happening in the market, changes in your own financial goals, even personal circumstances.
Right, life happens.
Exactly. So the important question is, how often are you really checking in on your big picture investment plan? Not just glancing at property performance, but seeing if the whole strategy still serves your long-term vision. Are you comparing your actual results to what you projected and digging into why there might be differences?
And you don't have to figure all that out in a vacuum either. The guide strongly recommends talking with experienced pros, financial advisors, seasoned real estate folks. Their outside perspective can be invaluable for optimizing your plan, especially when markets get weird or you're thinking about a major shift.
Yeah, stress testing your ideas, finding blind spots.
Totally. So, okay, bringing this all together, what does this deep dive really mean for your real estate journey? Well, creating a strong investment plan isn't a one-off task. It's a continuous process. Learning, analyzing, adapting proactively, staying plugged into market trends, understanding those economic indicators, keeping up with rule changes, it's all crucial for making smart moves and navigating with real confidence.
Expanding on that just a bit, remember that a truly well-crafted plan, it's more than just steps on paper. It represents a fundamental shift in how you approach building wealth. It elevates buying property from just, acquiring assets to a truly strategic pursuit. And that significantly boosts your chances of long-term financial success. The real estate landscape, it's always shifting. Always. Challenges, opportunities, they're constant. And your well-thought-out plan, that's your compass through it all. But here's a final thought. How might really engaging with each of these steps, we've talked about the research, the analysis, the financing, the management, and especially that continuous monitoring and adjusting, how might that commitment transform your perspective on what's actually possible for you in real estate investing?
Great question to ponder. Keep exploring, keep learning, and keep building that confidence. Thanks so much for joining us for this deep dive into crafting your real estate investment blueprint.